All right. Good morning. Good morning. Here we are once again, a nice, beautiful Friday morning. All right. And what you see up on the screen is the SKEW, the SPY, the VIX, and the QQQ. And we're going to talk a little bit about those today and why they're important to us. And so that's what's got coming, looking forward to. These are some really cool tools that we use, and I'm going to show you how we can use those with our wild eye, crazy eye, iron butterfly that we've been trading over in the futures market. Now, these are in the stock market, and I will tell you, if you're using the demo account, you cannot have access to these. Now, I'm going to have to double check on the VIX. The VIX might be available in demo, but I don't think so. I think you have to be in the real money account, in your real money account, to get access to these markets. Not the Q and the SPY, of course, those show up in your demo account, but the SKEW and the VIX. SKEW is the stock symbol, and then VIX. These are the two stock symbols we're going to be talking about today. And I'm going to give you a quick introduction. I've got nice little slideshow presentations for you. I've even created PowerPoints to kind of get the idea across to what they are. They're short PowerPoints, and I don't usually do PowerPoints here in the lab. We generally save those for our academic work at the university, but these are something that's important. I want to do a little academic work with you today. We're going to study the SKEW and the VIX, and we're going to show you how we can use those in our trading, and primarily with our wild eye, crazy eye, iron butterfly. All right, and here we go. We're on our way over to the futures market. We're going to fly, get in our little jet airplane, and we're going to leave New York City, and we're on our way to Chicago. Boom, just like that, we're in Chicago. All right, don't you wish it were that fast? Okay, so up in the upper left-hand corner, we have the 2-minute S&P 500, and this is the Chicago exchange, so that is the S&P 500 out of Chicago. So this is a futures market now. And over here in the right-hand corner, upper right, we have the Dow. Bottom right corner, we have the NASDAQ, and bottom left-hand corner, we have the little cousin Russell down there. All right, the market's going to open here in about, what have we got? 5 seconds? Yep, market's going to open in about 5 seconds. And we're going to watch these babies rock and roll for a minute. There they go. There goes the Dow. Look at it take off like a rocket ship. And then we're going to jump over and we're going to have our little lesson about the SKEW. All right, so let's just watch this opening bell for just a second, and then we're going to run over and talk about the SKEW. Losing my voice already, so I apologize. Once in a while, I'm going to have a drink of tea. All right, let's bring this thing up full screen. There we go. All right, so we're going to watch these things just for a second, and then we're going to jump over and we're going to have our lesson about the SKEW, because I want to put on a wild eye, crazy eye, iron butterfly. And I also want to show you the news, and I also want to show you what happened yesterday with our wild eye, crazy eye, iron butterfly from yesterday, which we did put on the S&P 500. All right. So we're going to talk a little bit about that. I've got a screenshot of what happened, and we need to talk about the news. So it looks like the market rallied first here out of the opening gate, 6:30 this morning. It took off like a rocket ship, and then now it's starting to flush back down. So we had some news. Let's go look at it. Here's what happened this morning. 6:30 in the morning, we had the core PCE price index month over month, and get out of the way so we can see. And here we are. Forecast was 0.2, actual was 0.2. No change. Personal income. What's PCE? Let's go look and see. All right, PCE is the price in it. Is that I thought that was, what does PCE stand for? I forgot. Consumer inflation calendar forecast. I forgot what PCE stands for. Is it the personal consumer? I don't know. Can't remember. But it was no change. Whatever it was no change. I can't remember. I'll remember here in a second. All right. Personal income month over month. So that was no change. Nobody got raises. It was 0.5, went up 0.3. Personal spending. Somebody know what core PCE is? Bruce, look that up for me. Personal spending month over month. There we go. That was 0.4 was the forecast. Actual is 0.2. That's not good. If for the stock market, that's not good. People are not spending money. They're not putting it into the businesses to make them more money. The PCE price index, PCE price index, 2 to 3. That was at 630, 630, 630. Price index. What's the difference between PCE price index and core PCE? I don't know. I'm going to do a little bit of research on this. These are a couple things I'm not exactly sure on. The personal consumption expenditure. That's what PCE stands for. Personal consumption expenditure. So this is all about people spending money. Oh, that's the one. Look at that. This is the one that personal consumption expenditure. Price for goods were up 2 and price for services increased 0.3. Meanwhile, the core index, which excludes food and energy, rose 0.2. So there's a good little description for us, Bruce, right there. All right. Finally, the annual PCE rate established 2.7, pausing after an acceleration in March, and the annual core PCE inflation were also unchanged at 2.8, both in line with forecasts. So no change. Looks like it's just been kind of the same. So I don't think we're going to see a whole lot of action out of that. And that's what we're kind of looking for, right? A little bit. It rallied up, and then it's just kind of coming right back down to the VWAP once again. All right, core PCs, Chicago PMI, Purchasing Managers Index. Now that one I know very well. And the PCA, the Purchasing Managers Index, look, that's going down, 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 down. And that's not good. That means that these purchasers, I used to be a buyer for the U.S. Navy. Did you know that? Used to work in a company that I bought computer equipment for the U.S. Navy, also for the National Library of Medicine, also for the Army. I used to work back in Washington, D.C. Yes, I did. I was a buyer. I bought all that stuff for the Navy and the Army and for the National Library of Medicine. It was a pretty cool job. I actually really liked it. Hughes Baker Oil rig count. Now we're going to get into oil stuff this afternoon at 11. And then Fed speaks after the market closes. So no real big news coming after, right now after the open. So 7:45, we got Chicago PMI, Purchasing Managers Index coming in 10 minutes. So that might, wow, look at the Dow. Look at the Dow. That thing's taking off like a rocket ship. I've been a little bit worried about the S&P. Let's go look at the daily on the S&P. I want to show you what's concerning me about the S&P. This here pattern that you're looking at right here, this here pattern is called a butterfly pattern. All right. So if you look at that, that's a little butterfly pattern. And we just tie those little wings off just like that. All right. So you've seen those before. If it were elongated a little bit, we'd call it a bat pattern. But this is a butterfly. All right. So this is a butterfly pattern. The thing about butterfly patterns is that they're very bearish. All right. That high wing up in there indicates that this market's going to flush. And usually it flushes back down to the body. So we look for that market to come all the way back down into this region here and test these regions down in here. This wing right here off that butterfly, that little hook right there, that's not a good pattern for bullishness. All right. That is a negative bearish pattern. So that market came up, broke that high right there. And I liquidated all of my long stocks when that thing got up there and touched right in here. I got out. Well, I took the last ones off. Last tailing ones that were making a little bit of money yesterday. And so I don't have any long stocks right now. I am not any long stocks. Now, I may be sad because it might just turn right here and blast and go to the moon. Could that happen? Yeah, it could happen. Let's look at the Fibonacci number off this last run. It could come right down here. It's bouncing off at 38.2 right now. So it could turn and rally, but it could come down a little bit further into this Fibonacci sweet spot range, which is what we generally expect, right? We generally expect the market to come down into the Fibonacci sweet spot. So this is where we're going to anticipate this market blowing off to. Man alive, I can't get any tools to work today. Here we go, down into this region here. And then we'll look for a little bit of a sideways move. And then maybe we'll look for it to start to rally once again at that point. And that'll depend on, the economics of the market and see what happens. But this is kind of what we're looking for on the S&P 500. I'm not long any I'm not long any stocks. I still have a few ETFs and a few bonds, and my portfolio is rounded out like that. But as far as the aggressive stock purchasing, I have taken that off because I don't think we're going to see a big explosion out of here. Now we could, and I could feel bad that I didn't get it, but I'll get back in. I mean, I can always get back in, right? So the reason I took off is because of that butterfly pattern, and in the past, butterfly patterns have been very bearish. So we're looking for that thing to come back to the Fibonacci sweet spot, and maybe a little further beyond. We got a couple little Ross stop signs in here. So we got that 50 period moving average, we got the 100 period moving average, and we got the 200 period moving average coming in here too. Got to keep those in mind. All right, we got to keep those in mind. All right, so that's what we're looking at on the S&P 500 and why I am not in the stock market to the long side. Doesn't mean it can't take off and go. Look, I mean, we're getting a 2-minute chart on here. This thing's, really doing quite well right now. It's busting some craziness to the upside right now. Let's come in here and turn on our ATR. And we're not quite back down to the VWAP where we want to put on our wild eye, crazy eye, iron butterfly. Speaking of wild eye, crazy eye, iron butterfly, let's go look at our yesterday's spreadsheet on this little baby. All right. So we're going to go look at our spreadsheet on here. And the whole reason, I'm just going to jump right back over here to the stock market for just a second. Watch how fast I can fly from Chicago to New York. Boom. We're back into the New York markets. The reason we are going to be looking at the SKEW and the VIX is because we're going to use these to help us decide what to do with our wild eye, crazy eye, iron butterfly, and with our stocks. All right. Bonds, we mostly, and I told you at one point I was going to teach you a lesson on how to retire with no money, no cash. All right. Can't retire on no money, but we can retire on no cash. So I'm going to, if you don't have any cash in the bank, we're going to show you how to retire. All right. And not today, though. I was going to do that today, but then I got distracted by the wild eye, crazy eye, iron butterfly, and I got distracted by the SKEW and the VIX. And I wanted to give you a lesson on these two very important markets. So we're going to push out how to retire on zero cash tomorrow. Not tomorrow, because tomorrow's Saturday. We're going to do that on Monday. All right. You guys are going to be here with me on Monday. We'll learn how to retire without cash. How's that? How's that sound? All right. So here's the S&P. It's rallying back up. We need a quiet market to put on our wild eye, crazy eye, iron butterfly. We can't be getting into this market if it's rallying and working hard. Let's see. So what I want to do is I want to go over to our screenshot. Now, this is the screenshot from yesterday's market. And we put on one wild eye, crazy eye, iron butterfly yesterday at the beginning of the market, as the market opened. All right. And this is all the S&P 500. So this is what we did. And we put one on, and then I put a second one on, and then I put a third one on. All right. And the reason I did that was because the market, it was doing its one thing, and it was making some money. The first one we put on first thing in the morning when you guys were here. I put that one on. And then the market went up, and it started to go sideways at a different price level. Now, our first one was making a little money. It just wasn't making very much, made it $100 or something. And then the market moved to a new level, new price level, and it just kind of stayed there. And I was like, well, are you going to ever come back down? I was like, well, if it's going to be that stable up there, I'll put on another one. So rather than roll it, which is what you can do, you can roll this one up from where it's currently trading up to a higher price. I didn't want to roll it. I just added another one on. Okay. So I just put another one on. Boom. Just dropped a second one in right there. So now I had two. And then it started to come down. And the day before yesterday, if you remember, I was talking about this thing and I was like, you know what? This dumb thing has come in here and it is saving and holding on to its value all the way until the very last minute. And so it came into, I was watching these two markets. I didn't put any of these on yesterday in my real money account. I was just watching the demo account and trying some stuff. So it came in and I had these two options on there and they were both doing okay. They were not ripping new, they weren't making a whole bunch of money, but they were making money for us and they were doing it slowly, which is what we like. I mean, you have to admit that when you're doing this wild eye, crazy eye, iron butterfly, it's going to pay you off slowly over the whole day period of time. It takes 6-7 hours for it to pay off. It's not immediate gratification. So they were just kind of trucking along, making a couple $100. And then I thought, you know what? It's we got about like 2 hours before the end of the day. I'm going to put a third one on. So I dropped a third one on in there. Only this time, I put them all three on the same ticket. Now, you know me, I like to put them on separate tickets. And the reason we put them on separate tickets is so that we can liquidate, take them off at 20% without taking off our insurance policy, right? So the idea here is that when we put these things on, we put them on separate tickets, and we put our insurance policy on a different ticket so that we can take them off at 20% or 25%. So we take it off at 25%, we put it back on, take it off at 25%, put it back on, take it off at 25%, put it back on. And so we keep doing that across throughout the day so that we can recenter our wild eye, crazy eye sold options at the delta neutral point, right? So that's why we do that. But that's when we usually have the insurance premium way out there at delta 20s. Now, we've also been working with hedging, right? We've been hedging these things. So we've been using different hedging tools. We started off using the autopilot, and we would hedge with the autopilot off of the VWAP and other methods. And then we also hedge with the magic stick, which, will reverse kind of the draw the line in the sand. If you go back and look at all of our videos, this is kind of the progression that we've gone through with these things. We've tested all these different ways of trading these different strategies. And the problem here is that the hedging is ending up costing us more money than if, by flipping from one side to the other, by doing that, than what it's worth to hedge, right? It's been chewing up all of our profits in hedging. And so I've been thinking, okay, we need to hedge because there's times where the market takes off and runs without us thinking it's going to. Now, we try to time this thing so that we can get into it when the market's not going to take off and run. So we get in on days where there's not a lot of big, huge news, right? We put on these iron butterflies when there's not a lot of news. And that makes it so that the market's quiet and calm. And wouldn't it be nice if we had a way of knowing that the market was going to be nice and quiet and calm? And that's what the SKEW and that's what the VIX are going to help us do. It's going to give us an insight into the market on whether it's quiet and calm or whether it's going to be active. And the news does that for us too. And of course, that's why we pull up the news every morning and we look at the news. So in this process, we've been using delta 20 for our wings. And then we switched over and we said, well, because of the delta 20 and it doesn't have really good protection. All right. All it does is reduce our margin. It's really lousy insurance. So we started hedging. Okay. And then we started hedging. We started thinking, well, why do we need to hedge if why do we need these outer wings if we're hedging? We really don't. They're kind of useless. The only reason we use them is to reduce our margin. So then we started pushing them out further and bringing them in. So they just almost didn't cost anything because they're basically worthless if we're going to be hedging. Then I started thinking, well, why are we hedging with contracts that make us money and lose us money, that make us money, lose every time it flips back and forth across the dead market? Because if we're going to trade a dead market, it makes it difficult to hedge because the market's dead, and so we don't make any money. But then suddenly the market takes off. If we don't have our hedge and we got our lousy insurance, then we lose money. So how can we have the best of both worlds? So I said, well, we can hedge with options. We're trading options. We can hedge with options. So that's when we started doing the testing of bringing the wild eye, crazy eye wings from delta 20 down to delta 50. Now, the problem with that is you can't put them all on the same ticket. Actually, you can in track and trade. You can't bring them down and put them all on the same expiration day. So you can't do the traditional, right, which is the traditional iron butterfly is just to sell two at the money and their buyer and a call at the money, and then sell a put and sell a call on the same ticket, all for the same expiration date. The problem with that is it makes it that those insurance policies become so expensive and you lose the entire premium of them. If you want them to have any kind of value to you, if you push them all out to delta 20 again, then they're worthless, but they cost enough that they dig into they don't do any good on if the market moves, and they dig into your profits quite significantly. So you bring them in a little bit closer. Now they're more expensive, and they do you better. They do good for you, or a little bit better for you if you have a market that takes off and moves. But then they're so expensive that then they chew up all of your profit. So they're worthless. So this idea of selling iron butterflies is just not a good idea. It just has never worked for me. And so that's why I just don't do it. And then I started to come up with the idea, well, the wild eye, crazy eye, iron butterfly is all based around theta. So theta is what helps us not reduce the price or reduce the value of an option very quickly. The reason we sell 0 days till expiration options is because the theta decays very quickly and we get to keep all that premium. The problem is if we got insurance policies, we got these outer wings, they decay very quickly too. And then they chews up all of our profits, worthless dumb things. So then bright-eyed Land, he starts thinking, well, theta takes longer to decay if it takes more days. If you spread that theta decay out over multiple days, yeah, it might cost you a little bit more up front, but they don't let it decay as much because they're worried that they might have to pay you off in the next day or two. So Bright Land, he starts putting out different wing dates then so that it becomes a calendar condor, right? Calendar condor means that the wings have different expiration dates than the body. And so that's why it becomes a wild eye, crazy eye, iron butterfly, because it's not a typical butterfly. It's something else. And so I decided to give it a fun and crazy name, and that's what I named it. And so it's the wild eye, crazy eye, iron butterfly because it's a calendar condor. And so we have wings that are at different levels. So we started doing tests with the wings out on outer levels, inner levels, and at the money. And because it's an at the money option, you can put it right at the money, and you can buy at the money while you're selling at the money because they have different expiration dates. And that's something a lot of people don't do. It kind of doesn't register in their head that, hey, if I sell something here and buy it here, it's going to cancel out. But that's exactly what we want it to do, right? Logic. Well, that's exactly what we want it to do. We're trying to hedge. We want to have a really good, solid hedge so that if the market takes off and runs without us, we get covered. But we also don't want to have to pay for that insurance. So how do we solve that problem? We extend the amount of time that the insurance covers for way beyond what we need. We don't need 5 days of insurance. But if we do, the first day of insurance almost doesn't drop at all unless the market really runs. And if it really runs, then it covers us and gives us good insurance. But we don't have to pay much of that premium because the premium dies at the end of the end of the time frame, not at the first. So we get very little decay on the first day. And if in 5 days we still hold on to them, well, we're going to get a lot of decay back in the end of the 5 days. Well, we're not going to because we don't really care about 5 days. We're just tricking the market. We're tricking the market. All right. So we get long theta and short theta on the sold, long theta on the bought, and we put them both right on top of each other. All right. And so that's what we've been doing lately. And that's what I did yesterday. I put that third one on and I thought, you know what? If we're going to do that, I can actually put them on the same ticket. So you can put them on the same ticket in track and trade. You just put the two short ones on one ticket and you put the third ones on the other ticket and you can liquidate the whole thing at one point. So I did that. So that was the third one I put on. And so that's why we got these 3 different iron butterflies that we put on. And I put that last one on all on the same ticket a couple hours before the market closed. So we ended out yesterday with $545. That's what I'm getting around to. And that's why we did that. All right. So $545, all 3 of them paid off. The least expensive one, the last one that I put on only traded for a couple hours. It made $100. All right. Something like that. All right, so that's what happened with our, oh, look, we're getting it back down to the VWAP. We can put on our wild eye, crazy eye, iron butterfly. Because the other idea is that if we're hedged this well with our at-the-money options, we don't need to hedge any other way, and we also don't need to keep taking them off at 25%. Because when you sell your options, right, they're going to give you, what, like $800, right, if you wait and hold it till the end of the day. Well, then why not? Hell, why not hold it till the end of the day? If you're hedged at a perfect hedge, you've got a hedge with your options at the money, and they're 5 days out, and they're not going to lose a whole lot of value in theta, but they're going to gain value if the market actually moves in your favor. In fact, that happened to us yesterday, right? We came in from our previous day where we had left our insurance policy on overnight, and it was up like $1,000. Our insurance policy had paid off overnight because I didn't drop it off. I just let it go. They paid us our premium from our sold options, and the next morning our insurance policy paid off with $1,000. Of course, by the time I took it off, it was like $800, right? But we made $800 on our insurance policy overnight. Now, I've left them on overnight before, and they've still lost money. So it goes both ways. Sometimes you make money, sometimes you lose money. But that money that you lose is covered by the profits from the previous days, wild eye, sold options. All right. Now you're like, oh my gosh, Lan, That was a great little lecture on the wild eye, crazy eye, iron butterfly, and how we got from there to here, all in one little 5-minute rant. Why have you got that written down for me somewhere? I'm glad you asked. Do I have that written down for you somewhere? Yes, I do, actually. I do have it written down for you, and I'm going to tell you right now how you can go get that. All that research for $1. How can you get all that research for $1? Because I documented that entire process that's been going on this entire month in Pit News Magazine. If you go subscribe to Pit News Magazine, the June issue, which comes out on Monday, that whole thing that I just described to you, all that stuff about the wild eye, crazy eye, iron butterfly, outer wings, inner wings, long calendar spreads, at the money, away from the money, how much time, 30 days, 20 days, 10 days, 5 days. It's all documented in Pit News Magazine in a great, beautiful article. All right, so I documented everything with charts and graphs and pictures, supplementals, everything. And then I even summarize it just like I just did. So that summary I just gave you is all summarized in the magazine. So go get the magazine. It's $1 for the first 3 months. So you get 3 issues for $1. And then after that, if you like it, if you want to continue with it and get all this great research that we do here, it's $49.95 for 1 whole year. All right. So just for the first 3 months, so you get 3 issues for $1 just to try it, see if you like it. If you don't like it, hey, it's not for you. Just cancel. You spent $1. That's all there is to it. All right. Just $1. And you get all that research that I just talked about, all documented for you. And it's actually even got an audio recording. So it reads you all that audio. So you don't even have to read the article. It's just there for you to reference all the charts and graphs and numbers. Okay. And to see how to do it. And then a nice, beautiful little summary that tells you all that stuff. All right. We're at the VWAP right now. So one of the strategies of this wild eye, crazy eye is that we want to put it on at VWAP. So we're going to come in here. We're going to put this on. And we're going to go down here to, I'm going to go down to 5 days. And we're going to look at our options. All right. So this is the options on the 2-minute chart. And we're going to look at our options chain here. And we're going to go out 5 days. And we're going to see what these things cost. $1,250. 5 days is generally good. We can go down to 4 days if we want to. We want to do quarterly, and there's no quarterly. The next quarterly is clear out to 21 days. But I've done a bunch of testing. And again, it's all documented in that article in Pit News Magazine. Just go over to pitnews.com and subscribe. It's $1, and you get this on Monday. You'll get all this research. That's 21 days is $2,900. I don't think we need to go out 21 days. And now, again, I document in the article in Pit News Magazine why 21 days is not better than 5 days. 5 days is kind of the best because it holds on to your theta long enough that you're not going to get a lot of theta decay, but you're not going to spend a lot of money. And a closer in, a shorter time frame is going to give you better insurance. So you could even go less than 5 days. You could go down to 4 days or 3 days. We don't want to go too much shorter than 2 or 3 days here. And we got a weekend coming in. This is going to be good. They're not going to want to move that theta because they got to sit through a whole weekend plus Monday. And they don't know what's going to happen on Monday. So you could put it out to 4 days. I think on this time, because we got a Monday, that we could do 3 days, $850. So we're going to go ahead and we're going to buy these. All right. So I'm going to just right click on them right here. I'm going to buy these and I'm going to put them on a separate ticket. Okay. Because I like doing that. So we're going to come in here and I'm going to, they're asking $36.50. The mid is $36.25. We're in the demo account. So we need to just go on up and pay them what they're asking, which is $36.50. $36.50, place order. All right, we bought our insurance policies. Now, we always need to buy our insurance policies first. You don't want to sell your options first, because if you sell your options first, then you're going to, boom, have this huge requirement for margin, and we don't want that. So now we're going to go and buy the exact same ones. We're going to go to 0 DTE, and actually we're going to sell these. So we're going to sell these, and we're going to sell them. We're going to get almost $1,000 in here. Look at that, 1,125. We're going to receive that. So now we're going to go ahead, and again, since we're buying, we have to go to the bid, which is 22. So we're going to go down to the 22, and you see that's going to cost us $37.50 in spread. We go ahead and place that order, and those are filled. All right, we got our wild eye, crazy eye, iron butterfly put on for Friday in the June contract on the S&P 500, and I'm looking at the 2-minute chart. All right, let's bring that back up. That's all set. That's ready to go. We are hunky-dory. Now, we need to go over and look at the SKEW. All right, we could spend a few minutes in here day trading if we wanted to. These markets, look at little Russell. He's up there. He's trying to get our attention with that nice little rally, isn't he? He says, "Hey, look at me, Lan. I rallied here, and now I'm flushing. Look, I'm going to rally again. You want to watch me rally again? If you do, then go ahead and buy into me. All right, but we're going to go over and have our lesson. We got a lot to talk about with the SKEW, and we got a lot to talk about with the VIX. And we're going to show how they're going to suddenly move the VIX and the Q into our wild eye, crazy eye, iron butterfly strategy. And I can promise you, in Pit News Magazine, in the July issue, there will be articles on VIX and SKEW. Now, they're not in the how we're going to add the VIX and the SKEW to our wild eye, crazy eye strategy in the June issue, because, well, June issue comes out on Monday, and we're just talking about the SKEW today. So it's not going to have time to get published and printed and put into the magazine by Monday, because the Monday magazine is done. It is done. It is got a stamp put on it, and it is just got a little bit of editing left to do, and it'll be done and ready to deliver to you on Monday, and all that great, wonderful new information will be there. Okay? So let's swing on over to New York once again, getting our little jet. We're going to leave Chicago. Boom. We're now in New York. All right, these are the New York markets. This is where they find the SKEW and the VIX. Okay, bottom left-hand corner, you see the SPY. Bottom right-hand corner, you see the QQQ. All right, that's the NASDAQ over in Chicago, or the S&P 500 over in Chicago. All right, but this is in New York, so this is the SPY. You can also do the SPX. SPX is 10 times bigger than the SPY. All right, so just keep that in mind. If you want a bigger market, you can do it on the SPY. The other difference between the SPY and the SPX is the SPY, it is settled out to is settled out to the shares, whereas SPX is settled out to cash. Just like over in the futures market, it's settled out to cash. All right, and that's because we have what? We already talked about this: American style versus European style options. So if you're over in the stock market and you're doing this wild eye, crazy eye, iron butterfly, and you want to probably do it on the SPX, because that's where you have your European style options, and they settle out to cash, and they're not going to, allow somebody to come in and take shares away midstream. All right, like they could do on the SPY. We talked about that. If you don't understand it, go look at a previous video. Plus, you know what? My bet is there will be an article about that in Pit News Magazine. Yes, there will be. What are the differences between and the advantages and disadvantages of American style options versus European style options? And why do we like to do European style options? In fact, it might already be in the magazine. I think there's a section in this magazine about that. Why we like European style options. All right. Okay. So let's talk about the VIX first. We're going to talk about the VIX. And so we're going to bring it up full screen. Let's bring the VIX up full screen. So there's the VIX. And here is the QQQ. I just got the QQQ laid underneath it, so you can kind of see what the QQQ looks like as the VIX moves higher and lower. But you got to understand why the VIX moves higher and lower. And so for that, I have prepared a little lesson for you. All right. Now, I apologize. I threw these together very quickly because I just want to give you a description of what the VIX is. And there's a lot of text on my spreadsheet. There's not a lot of pictures. Sorry for those of you who want pictures on your PowerPoints. Come back another day. Today, a lot of text. So let's just read it. It's not very long, just a little bit of a description. And we are going to go through and learn a little bit about what the VIX is. All right, the VIX. The VIX, or the Volatility Index. Before we get started, let me take a drink of tea. All right, we're back. All right, little tea helps me read. All right, here we go. The VIX, or the Volatility Index, is a popular measure of the stock market's expectations of volatility implied by S&P 500 index options. That's my PowerPoint voice. The VIX is often referred to as the fear gauge or fear index because it tends to rise when market's uncertainty and fear increases. All right, the fear index. That's why we call it the fear index, the VIX. All right. Calculation. The VIX is calculated by the Chicago Board of Options Exchange out of Chicago. Hey, this is a calculated index from Chicago, but it's over in the New York Stock Exchange. And the symbol is VIX. You just pull it up. It represents the market's expectation of 30-day forward-looking volatility derived from the prices of the S&P 500 index options. That's very important for us to understand how they are calculating the VIX. They're calculating it on the 30-day forward-looking volatility derived from the options on the S&P 500, which is exactly what you and I are trading with the wild eye, crazy eye, iron butterfly. Now, can you see the correlation and why this is important for us? All right. Value interpretation. The VIX value is expressed as an annualized percentage. All right. For example, a VIX level of 20 indicates an expected annualized change of 20% in the S&P 500 over the next 30 days. There you go. So if you look up and down that column over there on the right-hand side, if the VIX gets up here into 2137, which is what it touched right there on April 19th, you're going to expect the market to move, the S&P 500, to move 20% during that time frame. Look at back over here. You're going to expect the S&P 500 to move 23% over that time frame. Well, how about that? That's pretty cool. Let's pull up the S&P and let's get rid of the Qs down here. I just want to use the Qs as an example on the VIX. So we're going to go ahead and let's change places with this. And we're going to remove that one. And now that's the S&P, which looks basically the same as the Qs, right? So that is what it's measuring. That's pretty cool, right? So if it's up here in the 20 percentile range, that means the market's going to be very active, all right? Very active. So logic, think, when do we want to put on our wild eye, crazy eye, iron butterflies? When the market is very active, right? No. No, we don't. No. Drink some tea. We don't want to be putting the wild eye, crazy eye, iron butterfly on when the market's very active because it's a neutral option strategy. We don't want the market to go anywhere, right? We just want it to sit dead. So when's the optimal time for us to be putting on the wild eye, crazy eye, iron butterfly? Well, I would say anytime the market is in the channel of being dead. This is when you want to be putting on the wild eye, crazy eye, iron butterfly. All right, because the market is just dead down in here. So if it's just dead and it's ringing along down here, it's not going anywhere, it's not doing anything, the volatility or the fear index is very low. So this would be a good time to be putting on wild eye, crazy eye, iron butterflies. Now, if you remember, we had some losers on the wild eye, crazy eye, iron butterfly a couple of days ago. And where was the market? It was up here doing some of this stuff. It was getting crazy, right? And so during the crazy times, that's not a good time to be putting on a neutral option strategy. We want to be trading options long or short to the market. So that's what the fear index does, or the VIX tells us. So if you can see, the crazy thing is, see, this was all really quiet market through here, but look, the market made a beautiful uptrend during that time. Look at that. And then the fear index went crazy through here. Look at that. Now it's rounding out. It's coming up. It's maxing out. It's breaking those blue lights. It's giving us that butterfly pattern. We're looking for a pullback, aren't we? And look what's happening. Fear is starting to go up again. All right. So keep in mind that when the market's making little tiny bars and it's not making big runs, you get this kind of stuff. Now look right in here. The little fear index came in here. Now, and then we had big fear right in here. Now, I'm not sure if I've got those on the same scale, but it looks pretty darn close. So that's kind of what we're looking at. All right. I probably need to tighten that up just a little bit. Let's bring this in just a little bit. Boom. We'll do one more. I think that's probably a little closer to what we're seeing. Yeah, probably more like that. Okay, so we're seeing this come down here. And we're seeing this up here. Oh my goodness, not seeing. I hate it when that happens. Man down. Okay. Start over. All right. Here is the VIX up on the top window. And here is the S&P on the bottom window. And Land's got to pay more attention because it's that stupid thing. I put it over there where if I put something up, that slides go up and then they don't switch automatically. That's why I started doing things like this. And I should have done that, and I apologize. I thought I was going to be smart and be able to do that today. Can't manage it. All right. So Land's a newbie at this YouTube stuff. I'm not fancy enough to have somebody over there in the corner helping me. I have to do it myself. All right. So back to what we were looking at. Let's get rid of all the drawing tools here. We'll start over. Okay. So from this point on, what we're looking at is the fear index. Now we need that back up. The fear index says 30-day forward-looking volatility. So if the VIX at level 20 indicates our expected annualized 20% return over the S&P 500. Now let's go back, look over the S&P 500. All right, so now we have the S&P 500. And this is the location in which you want to have a very quiet market. This is where the market's going to be quiet, a low fear index. All right. If we have a high fear index up here, this is a high fear index way up there at 2137. Here it is way up there at 2312. So if the market's way up here touching these high points, we do not want to be putting on our wild eye, crazy eye, iron butterfly. These are places where you'd want to trade long and short positions based on the market trends and the patterns. All right, this is lots of trading going on in here. You're going to be making longs and shorts and trading the markets. This is where the market's neutral, so lots of neutral strategies are going to be good. But here's the weird thing is look at this. During this entire neutrals time frame through here, this is where the market made one of its best runs. Look at that huge run it made during that quiet time frame. Now, if you remember, we had a lot of hard times making money day trading during that time frame. Why? Because the bars were real small. They didn't move a lot during each day. The volatility was very low on each day's bar, and so it caused these markets to kind of, not be very volatile. And so the VIX stayed down here in this low region, which is really surprising to me. I thought we'd have, for such a nice, big, beautiful run, we would have more volatility, more fear, but there was less fear. So this was when we had our nice 3-drive pattern down, drive 1, drive 2, drive 3. The market was coming down hard and the fear was very high. So that makes sense, right? Oh, market's flushing. The fear is high. What the heck is going on? But the bars were small anyway. They weren't great big long bars. Some of them were pretty good size. I mean, these are squished down quite a bit, but that's kind of an interesting fear index right there. That's what I want to point out. We want to put our iron butterflies on during real small bar days. We don't want big long days. And we're generally going to find that when the VIX is down here. Now, let's go over and read the rest of this thing, and I'll try not to forget to turn it off. All right, so market sentiment indicator. A high VIX indicates high volatility and significant fear or uncertainty in the market. This usually corresponds to periods of market stress or downturns. All right, so let's go back and look at our chart again. So a high VIX, stress or downturn. So we got a high VIX. This is where they're saying that we generally get a fall in the market. All right, so that's where you get this big fall, and then a high VIX, a big fall. Okay, so that corresponds quite well with what we're seeing in our chart, right? So let's go back over here. Low VIX indicates low volatility and greater investor confidence. This usually corresponds to periods of market stability or growth. All right, so again, back here, low. So this is our stable time frame. So we get growth. Well, and that's what happened right in here, right? Big growth spurt while we had low VIX. All right. Well, that's really cool. If we understand that from the concept of what's going on here, let's get rid of all our drawing tools, that we have anytime the market is down in here, we're going to anticipate nice growth. Now, we've got something going on not working that way right now, right? Well, the market is starting to rally. Well, this is a daily chart. This is a daily chart. We're down in the growth state. This market started to rally, well, and it started to grow. So this, are we going to kind of line it up a little bit better? April to April. There's April. April to May. We got to, this is a little bit small, so we got to enlarge this one. I'm trying to get them equal. So we can get April to April right there. April to, there we go. So this time zone, let's look at April to April. So this is April, April to May, and then we had April to May. So if you read that one more time, I think it's important to read that one more time. High VIX indicates high volatility and significant fear or uncertainty in the market. This usually corresponds to periods of market stress or downturn. A low VIX indicates low volatility and greater investor confidence. This usually corresponds to periods of market stability or growth. All right. So high VIX, markets down. Low VIX, markets up. I mean, it really comes down to be that simple, right? All right. Let's go back to the next one. Risk management. Hedging. Investors and traders use the VIX to hedge their portfolios against market downturns. Portfolio adjustment. A rising VIX might prompt investors to reduce exposure to riskier assets or adjust their portfolios to mitigate potential losses. So that's what we're all about here, right? We want to know when markets are going to trend and when they're not going to trend, when they're going to move and when they're not going to move, when they're going to rally and when they're not going to rally. And the VIX helps us with that. All right. It's also a little bit of a self-fulfilling prophecy. They started making it and then people start following it and it does what they say. So it works that way too. There's a little bit of that going on here with the VIX. All right. But the VIX is very popular. Most of you have probably heard of it, and that's the reason why. All right. So let's go look at it one more time. Speculation. Traders can speculate on the future direction of a market's volatility by trading the VIX itself or one of the popular VIX ETFs, such as VXX, which can be profitable in times of expected market turbulence. All right, let's go back over to our software, and I have the VXX sitting here. Let's pull up the VXX. So this is actually an indicator or a ETF, ETN in this case, exchange traded note, not an exchange traded fund. A little bit of a difference there, but not much. We could talk about that another time. In fact, I've talked about it in videos previous, exchange traded notes versus funds. So if you're interested, you can go find that. But nonetheless, they're not that much different. Just think of them about the same. And then the VIX here is the CBOE 500 index, and the VXX is an ETN, exchange traded note, and you can actually trade these. All right. So you can actually trade these. A lot of people use them for hedging purposes, and we know what hedging is. If you're long the market, you can hedge by going short the market on the other side so that it kind of offsets your position, puts you into what we call a spread. All right. So that is the ETN VXX. Let's just move that back down. I just want to throw that up there for you quickly. We'll come back over to our little slide, and we got one more here. Market analysis, comparative analysis. VIX trends can help investors understand broader market trends and investor sentiment. This can be useful for making informed investment decisions. All right, practical considerations. Not a direct market indicator. While the VIX is a useful indicator of market sentiment, it does not directly predict market direction. It does a pretty good job of it, though. High VIX levels indicate expected volatility, not necessarily market declines. It's just a lot of volatility, okay? Short-term indicator. The VIX reflects short-term market expectations and can be highly reactive to immediate news and events, making it more suitable for short-term analysis and strategies. Okay. Let's go over to our next slide. And in summary, the VIX, let's come up here so we can see. The VIX is a crucial tool for investors and traders to gauge market sentiment, manage risk, and implement trading strategies. Its role as a fear gauge makes it a key component in understanding market dynamics and investors' behavior. Simply put, if the VIX is down, markets are calm. If the VIX is up, markets are wild and active. It's all relative. All right. So that's kind of the idea of the VIX. All right. So any questions about the VIX? I think that covered it pretty well. Let's go over and talk about the SKEW, because the SKEW, I mean, as much as I like the VIX, I think the VIX is pretty awesome. I love the SKEW even more. You what, lad? That's pretty cool. And you got something even cooler than the VIX? Yes, I do. Let me take a drink of tea and I'll go show it to you. The SKEW is even more fun and way cooler than the VIX. The cool kids use the SKEW. All right. So the SKEW index, also known as the CBOE SKEW index, because it comes from the Chicago Board of Options. Okay. So we're going to come in here. The SKEW index, also known as the CBOE SKEW index, is a measure that qualifies the tail risk of the distribution of S&P 500 returns. What? What's a tail risk? Essentially, a tail risk reflects the market's perception of a likelihood of a significant, unexpected move in the S&P 500. Now, wouldn't you like to know when that's going to happen? All right, the left tail is an extreme negative return, large losses, and we see that in all around the world, and I'm not going to mention specific places, but the left, once again, is negative. All right. The right is an extreme positive. Okay. So right tail is extreme positive returns, large gains. Okay. So let's go over. I'm going to read that one more time because it's very important for you to understand. Left tail is extreme negative returns, large losses. Right tail is extreme positive returns, large gains. It's going to become more important as we move forward. All right. The SKEW, how it's calculated. The SKEW index is calculated by the Chicago Board of Options Exchange using the prices out of the money S&P 500 options. Oh my goodness, not out of the money S&P 500 options from Chicago. Where are we trading? In Chicago. What are we trading? Options. All right. We're no longer trading out of the money options, though. We're going to trade at the money options. It measures the difference between the implied volatility of these options and the implied volatility of the at the money options, which is what we're trading. We like to trade the at the monies. Okay. Now, the value interpretation. The SKEW value between 125 and 140 indicates a normal distribution of returns, similar to the VIX, reflecting no significant skewness. So if we swing over, I'm going to come back over to the software. And if we look at the VIX, we have a normal distribution. Where's normal distribution? It's this box right down here. All right. Box down here is the normal distribution. If it leaves that box, well, we have high volatility. Let's go over and do the same thing with the SKEW. So I'm going to pull up the SKEW now, and I'm going to get rid of the VIX. I'm going to replace the SKEW, and we're going to get rid of the VIX. This is the SKEW. Now, the SKEW I've got set here as a single line. You could come in here and go price bars. You go open, high, low, close, but there's no reason to have open, high, low, close. I like to just come in here and price bar type. I like it to just be close only. Just gives you a line, because that's what we're really looking at this as a line. And if you want to think about it, because you're very familiar already with something called the stochastics indicator, right? You guys all know stochastics indicator. Stochastics indicator is an overbought, oversold region type indicator. If the market is above the high region, it looks for it to come down. If it's below it, looks for it to go up. Well, think about the SKEW basically the same as an overbought, oversold indicator. All right. So we're going to come back over to our slide. And simply put, if the VIX is down, markets are calm. If the VIX is up, markets are wild and active. It's all relative. That's the wrong slide. Let's go back over to the SKEW. The SKEW value above 140 indicates a higher probability of a substantial negative tail event, i.e. a market crash. Values typically range between 125 and 150. All right. So this is very important. The SKEW value between 125 and 140 indicates a normal distribution of returns similar to the VIX, reflecting no significant skewness. The SKEW value above 140 indicates a higher probability of substantial negative tail event, i.e. a market crash. Values typically range between 125 and 150. So high SKEW suggests that investors are increasingly buying out of the money put options to hedge against the risk of significant market decline. This implies a higher perceived risk of tail events or market crash. A low SKEW indicates lower concern about a significant market decline, with fewer investors seeking protection through out of the money put options. Market sentiment analysis. Investor behavior. The SKEW provides insights into investors' behavior and sentiment, particularly regarding the fear of extreme negative events. Analysts use it to understand broader market concerns beyond what the VIX indicates. Different perspectives. While the VIX measures overall market volatility, the SKEW specifically focuses on the perceived risk of extreme market moves. Together, they provide a more comprehensive view of market sentiment and potential risk. So comparing the SKEW, the VIX, and the S&P 500, you get your 1, 2, 3 lands knockout punch. All right. Oh, that's an overused phrase. The SKEW index is a valuable tool for investors to gauge the market perception of tail risk and extreme negative events. It complements the VIX by providing additional insights into market sentiment and the demand for protection against significant market declines. Basically, a high SKEW indicates a scared market buying lots of put options as protection. All right, so that is it. So that last sentence kind of summarizes the whole thing. I'll read it one more time. Basically, a high SKEW indicates a scared market because they're buying lots of put options as protection. So we all know that put options are the way you protect yourself against a down market. So what they're doing is this just is really telling you, simply put, all that slide said was people are buying lots of put options. Lots of put options are being bought right in here. That means that if people are buying put options, they're hedging against the S&P 500. These are S&P 500 put options. They're buying put options because they think the market's going to fall. All right. So anything above 140 is our scale here. I got 120, 140 put on here. And so anything above 140 is very nervous. They're starting to get nervous. If it's below 120, they don't have any put options at all. There's no hedging. There's no protection at all. So you can see that channel in there kind of is your channel, and you can go back in time and you can see how that corresponds to where markets were. So June, where's April, May, June 2023 is like this. So line that up. They were not scared at all through this time frame. They were not scared at all. So what was going on in November 22, December 22, January 22, February 23, March 23? This was a very non-scary time. They had no put options at all. All right. And then as the market started to go forward, things started to come into the neutral zone. They started putting on a few put options, not very many. And then as the market moved forward, let's bring them both forward at the same time, the same rate. You can see right here, they started to get really scared. Market was really high at that point. They were starting to get worried that the market was going to come down. And then it did. It came down a little bit. And then they didn't get scared. They took their puts off. And then the market started to go up again here. They started getting really scared because the market was really high. You didn't have all this out here. This was the highest the market had ever been. They were really scared. And then the market comes down, it starts to go back up. They're not scared. And then they start hedging again. Once it starts getting up here, they're scared. They're scared. And the market comes down. And then the market started to go up again, breaking above this high. They got really scared right here. In fact, if you draw a line across this peak here, they got really scared right there. This is as scared as they've been. Look at this scary. Oh, they were scared right there. They're scared because they're buying put options, thinking that market's getting way up there. It's getting toppy. It just broke the previous high. That thing's getting scary, scary up there. Okay, so now we're going to come across. We'll bring it out to the next level. And we'll bring this one out to the next level. Line up. November. There we go. Now look at the scared little folks. How scared they are. Let's get rid of this line. This is our line right here of scare. Anything above that, they're scared. And look, this thing got so scary right up in here. Woo, they got scared up in there. And then the market flushed a little bit, started to go up again, and they weren't so scared. It started to go up, and then they started to get scared again. They started getting scared right in here. And these scaries were the highest scaries they had been compared to anything back in the further. Look how scared they were. Whoa, they were scared. And then look at this. Now they're scared again. Really scared. Scared the market's going to fall. And that's what that's telling you. They're buying puts because they're scared the market's going to fall. All right. So if it gets way up there in the scary, scary parts, they start buying puts because they think the market's going to go down. That's why I like the SKEW, because we look at that and we're like, whoa, they're scared the market's going to go down. And then you look at you line it up with the bulls and bears, because the bulls and bears kind of really telling you the whole inside of what the world's doing. So that's why we love the bulls and bears, because it kind of gives you, in combination with the SKEW, you look at what's going on and you're like, whoa, This gets up here scared, and then they're buying put options because they think the market's going to come down, and then you see a break in the bulls and bears blue light. Look at that. And then you see right here another big break in the bulls and bears blue light. We didn't get the break right here on this scare zone because it happened right in here, and it started to rally once again right there. They started to take it up once again. So that's a nice little tool, and I think you can use that in your trading and realize when people are scared and when you can buy and sell against these different markets and anticipate whether the market's going down or up. And you can use that to help make your Fibonacci projections on the market. So if we come down in here to the S&P 500 and we're like, hey, they're scared that the market's going to fall, and we're getting a bulls and bears blue light right here, well, we're going to probably have some kind of a blow off because they're scared that the market's going to fall and it's breaking the blue lights. That's why I liquidated all my long positions. Plus, we have that recurring price pattern that tells us that this is a danger zone. It's that little butterfly pattern, right? And butterflies are very bearish off that right wing. So that right wing butterfly pattern is very bearish, and we got a scared market telling us that's scary. So we can take our Fibonacci projection tool and we can say, okay, we can go like this. Up, down, how far is it going to come back? And we can make that Fibonacci projection tool. Okay. So that's how we read the SKEW and the VIX. All right. I hope that was helpful to you. Let's jump back over. We're going to get in our jet plane. And we're back over in Chicago. All right. This is the Russell. Russell's dead. Went up, made that nice little run. Now it's sitting there right at the VWAP. Let's bring up the other markets. And I'm going to bring this down. And, oh, look at that. Let's go look at our accounting. That thing blew right past the VWAP and started to fall. Let's see if it'll turn and come back up to the VWAP in a little while. Let's go into our positions. And we have our two. We're up 160 on our bot calls, and we're down 285. But that's so overall we're down $100. But we're up. Look, our insurance policy is performing for us. It's doing well. It's up $162. Not too worried about this one. It's down to 80. We'll see. We've got cost basis on it is $1,800. What? No, that's the wrong one. Cost basis $1,125. So they're going to give us $1,125 against the 330, but we got 205 of insurance paying off right now. We're only down 120. So we're still in good shape on this. That's why I like that at the money insurance policy, because it pays well. And it's a short days till expiration, only 3 days. So it's going to be very sensitive to the market movement, as opposed to if we went out 30 days, it wouldn't be very sensitive to today's market movement. And so it wouldn't be up $265 right now against our 465 down on our options. So we're 165. We're only down 165. Market's tanking. Okay, the NASDAQ's starting to turn and come back up. Maybe the S&P will turn and come back up here in a minute. Don't get nervous. Don't fiddle with it. Let it sit there for a little while and let it ruminate. Let's find out what's going to go. We can always roll later. We can roll this afternoon if we need to, or we can add another one on this afternoon if we need to. But we're not going to get all nervous and bent out of shape, because markets swing up and down past that VWAP, right? We just need to come back to the VWAP. We'll be okay. Not too worried about it. And we'll see. We may have to do a little mitigating, but I'll let you know tomorrow, actually Monday, what happened with this one too. All right. Oh, you can't see it. Doggone it. There, you can see it now. There we go. 265. We're down 420. So for a total of down 150. So our insurance policy is performing well. If we had those Delta 20s, they wouldn't be making us $272 right now. I can promise you that. All right. With those Delta 20s. And also with if we had a Delta 30, or if we had a 30-day option on that at the money, it wouldn't be doing that either. This is the short-term at the money option that's performing like that for us. So it's keeping us not feeling so scared. See that? We're only down $140 against that position. So everything's cool. Everything's copacetic. We're all happy. Don't get freaked out. All right, let's go say hello to some people before we say happy weekend. Let's come in and see how things panned out this morning. Bruce, first one up and out of bed this morning. Good to see you, Bruce. I got to drink some tea. Good to see you, Bruce. In number one spot, we got Kirk following up in the silver spot, and Gary Thomas coming in at number 3. Good to see you guys in here first thing in the morning. Michael Bruce coming in at number 4 with the bronze. Bruce says, Pit News Magazine is awesome. Great. Thanks for the compliment. Vote of confidence. I'll tell you what, these little, Bruce, these little slides, would you guys like to have these? I mean, they're just nice little notes for you to know what to do and what to think. They got some numbers on there that are important. If you want to keep some of these numbers like this right here, these are good numbers to have. I will give you these slides. How would you like them? If you have Pit News Magazine in the email, I will give a link to these slides in the email on Monday. So anybody who subscribes to Pit News Magazine will get these. All right. So if you don't subscribe to Pit News Magazine, it's just $1. $1, and you can have those slides. Plus, you get Pit News Magazine and all of the information that we've done here. Plus, there's a lot of other articles in there too. That's not the only article in Pit News Magazine. I mean, the Pit News Magazine has like 5 or 6 great articles. There's a good seasonals article in there that comes out every month. We got a great seasonals article coming out this month. All kinds of wonderful things in Pit News Magazine. But I will include links in the email. So watch in the email, because that's where I also update the spreadsheet, right? Oh, we were going to go update our spreadsheet. You guys want to do that with me, or you want to go do that on your own? Small account spreadsheet. Oh, I already did it. I already put it in there. $545. So put on 3 wild eye butterflies. All 3 had 1 day to expiration delta 0.5 hedge. 1 I took off at break even. It was profitable until power hour. When the market tanked, I got out at break even. Oh yeah, that's the one I put on at the end. Remember I told you I put one on where I put them all on the same ticket, and it was making money. I think it was up like $100, and then it went into power hour. And if you remember, power hour started shooting all over the place, and so I just took that one off at break even. The other 2 did well. I purchased them earlier in the day. Note to self: I would have been way better off had I closed those positions out before power hour. That's part of our little rules, right? We like to get out before power hour, and I didn't do that yesterday, and it cost me about, I would say it probably cost me about $400 or $500 because I didn't get out at before power hour. So it was only $545 profit yesterday. But we had that rock and roll $16,000 options, and we did that yesterday. If you want to go look at that video yesterday, that's where we closed out 16,000. And then we put on a trade or 2, I think, just goofing off day trading. We had $25 in day trading. But our goal, look at this, our daily goal has risen to $548, and that's at 1%. So 1% a day, and we're up to 548. Our goal is $7,000 this month. So far, we're up 12,000. So we're over our goal by $4,600, and that's with all of our goofing off. So we've done pretty good. Not too shabby, right, guys? So it's good to keep track of what you're doing, so you know whether over the long haul you're doing well. Because when you have days like this, it makes you want to quit, right? It makes you want to give up. Or you have a run like this, you're like, man, I can't day trade. I suck at this. I've lost every single day. Well, go look at the VIX, go look at the SKEW, see where the market was. Was it active? Was it scared? And, look at the long haul. Make sure you're doing your spreadsheet. And if you want this spreadsheet, again, I will update it, and it'll be part of Pit News Magazine. You get it for free when you subscribe to Pit News Magazine. In the email that comes out, there's links at the bottom with all this fun stuff that you get as a subscriber to Pit News Magazine. So you'll get this updated spreadsheet. And if you like to look at all my notes, they're all in there. I leave it all in there. I leave it all in here so you can come in and see what we did and why we did it. All the notes are there. And then, of course, you can delete all this stuff out, copy it, create your new spreadsheet, and use it as a template for your own trading. All right. And even if you're day trading, even if you're still in your demo account, it's really super important that you track your demo account just like we're doing here. Hold your own feet to the fire. You got to hold your feet to the fire with your spreadsheet. That's what your spreadsheet is. It's the fire on your feet. All right, let's go see if our numbers are. That's 22. Yep, so we got 22, 3 losses, 25 days. We're averaging $498 a day. If you look at that and you see that you got a win-loss ratio of 7 and a batting average of 88, you can wipe the sweat off your brow and you say, hey, I'm not doing so bad. All right, I'm not doing so bad. I have bad days. Yes, we all have bad days. We all have bad streaks where we have bad losing streaks. But overall, hey, we're doing pretty darn good. And we've had a rock and roll winner right there with our stock options. And so, it all comes out in the wash, and you're making a little bit of money, and you're putting that in the bank. And, maybe you're not at this level. I'm only doing one on everything. This is singles on everything. I have not doubled hardly anything. Well, this one I did. I did 3. Right? I did 3. And we did some pretty good. I think the big winner on that one was still a single option in the stock market. The big winner was which one? It was Nvidia, right? We just bought one option on Nvidia. It wasn't like I went out and bought 10. It wasn't like I went out and bought 50 options and we made all this money. Oh, look, I'm so great at this. I hit one that had 50 options on it because I put on 50 options, or I put on 15 contracts and I made a whole bunch of money. No, we're not doing that here. Everything we've traded here has been the smallest incremental number that we possibly can. Yes, I did 3, but I did 3 quantity ones. I put on a single, I put on another single, and I put on another single. So they were all managed independently as single trades, one quantity ones. Everything we do here has been quantity ones. Rarely, even in our day trading, do we do anything more than quantity one. So this is all just beginner quantity one trading. All right? I'm not trading 15 contracts, I'm not trading 20 options. We're trading one. All right? So we're being cautious and careful. All right, the market's turning. It's starting to come back. We're not too nervous here. We're down $130. No big deal. All right. So that's what we got going here with the spreadsheet. You'll get the spreadsheet for free with Pitt News Magazine. Just go over to pittnews.com, pick it up, and you'll be good. You'll have those two. You'll have these two presentations. You have them on Monday. Monday morning. Actually, probably Monday afternoon. We'll probably have class, and then after the class is over, we'll send out Pitt News Magazine on Monday. All right, guys. Any other questions before I let you go? Let's see. We got some. Kirk, you're welcome. That's what Pitt News Magazine is all about. It's all about, taking this information that we learn here in class, summarizing it for us, and putting it into Pitt News Magazine so we have it and can remember what we did, the hard work we put in. Michael Bruce says, Lan, I just watched yesterday's class. I could not stop laughing when the spread was rising on the options to liquidate them. The spread was rising on the options to liquidate them. Were you talking about the very first thing in the morning and we were up $1,000 and then suddenly we were down to $800? Is that what you were laughing at? Kirk saying PowerPoint would be nice to have. Yes, you'll get it, Kirk. I recommend those notes in my book. I recorded those notes in my book, Lan. Good. All right. Write them down. Put them on there. But you'll get the slides. You'll get the slides on Monday. All right. And then you can use those numbers. All right, guys. I'm going to let you go. We're going to let this thing run for the rest of the day, and I'll let you how it turns out on Monday. No Sunday school lesson. We've already looked at enough slides. So I will let you go for the evening or for the day, and have a good day. And I can't think of anything else. I'll see you on Monday.